Forms of business organization. Learning objective. Explain common forms of business ownership, sole proprietorship, partnership, and corporation, and demonstrate how they differ in terms of their statements of financial position. Owner's equity is one of three major elements in the basic accounting equation. Regardless of the form of organization, owner's equity represents the interest of the owners in the assets of the reporting enterprise. For a sole proprietorship, owner's equity consists of the interest of a single owner. For a partnership, the ownership interests of all partners are added together to determine the total owner's equity of the enterprise. For a corporation, which may have many owners, the total contribution to the enterprise represents its owner's equity. In all cases, the enterprise's net income is added to owner's equity. The three forms of business organization we will discuss are sole proprietorship, partnership, corporations. An unincorporated business owned by one person is called a sole proprietorship. Often the owner also acts as the manager. This form of business organization is common for small retail stores, farms, service businesses, and professional practices in law, medicine, and accounting. In fact, the sole proprietorship is the most common form of business organization in our economy. From an accounting viewpoint, a sole proprietorship is regarded as a business entity separate from the other financial activities of its owner. From a legal viewpoint, however, the business and its owner are not regarded as separate entities. Thus, the owner is personally liable for the debts of the business. If the business encounters financial difficulties, creditors can force the owner to sell his or her personal assets to pay the business debts. While an advantage of the sole proprietorship form of organization is its simplicity, this unlimited liability feature is a disadvantage to the owner. An unincorporated business owned by two or more persons voluntarily acting as partners or co-owners is called a partnership. Partnerships, like sole proprietorships, are widely used for small businesses. In addition, some large professional practices, including CPA firms and law firms, are organized as partnerships. As in the case of the sole proprietorship, the owners of a partnership are personally responsible for all debts of the business. From an accounting standpoint, a partnership is viewed as a business entity separate from the personal affairs of its owners. A benefit of the partnership form over the sole proprietorship form is the ability to bring together larger amounts of capital investment from multiple owners. A corporation is a type of business organization that is recognized under the law as an entity separate from its owners. Therefore, the owners of a corporation are not personally liable for the debts of the business. These owners can lose no more than the amounts they have invested in the business, a concept known as limited liability. This concept is one of the principal reasons that corporations are an attractive form of business organization to many investors. Overnight Auto Service, the company used in our illustrations, is a corporation. Ownership of a corporation is divided into transferable shares of capital stock, and the owners are called stockholders or shareholders. Stock certificates are issued by the corporation to each stockholder showing the number of shares that he or she owns. The stockholders are generally free to sell some or all of these shares to other investors at any time. This transferability of ownership adds to the attractiveness of the corporate form of organization, because investors can more easily get their money out of the business. Corporations offer an even greater opportunity than partnerships to bring together large amounts of capital from multiple owners. There are many more sole proprietorships and partnerships than corporations, but most large businesses are organized as corporations. Thus, corporations are the dominant form of business organization in terms of the dollar volume of business activity. Of the three types of business, corporations are most likely to distribute financial statements to investors and other outsiders. The owner's equity section of the balance sheet will look different for each type of business entity. For a sole proprietorship, which is owned only by one person, there will be a capital account for the owner, reflecting the equity of the owner on the balance sheet. For a partnership, each partner has a separate account, where changes are tracked over time. The partner's equity is shown on the balance sheet. A corporation will show owners' contributions in the capital stock account and accumulated earnings of the company in the retained earnings account. You should be able to tell the form of business by looking at the equity section of a balance sheet. Investors and creditors use financial statements in making financial decisions. That is, in selecting those companies in which they will invest resources or to which they will extend credit. For this reason, financial statements are designed primarily to meet the needs of creditors and investors. Two factors of concern to creditors and investors are the liquidity and profitability of a business organization. Creditors are interested in liquidity, the ability of the business to pay its debts as they come due. Liquidity is critical to the very survival of a business organization. A business that is not liquid may be forced into bankruptcy by its creditors. Once bankrupt, a business may be forced by the courts to stop its operations, sell its assets for paying its creditors, and eventually cease to exist. Investors also are interested in the liquidity of a business organization, but often they are even more interested in its profitability. Profitable operations increase the value of the owner's equity in the business. A company that continually operates unprofitably will eventually exhaust its resources and be forced out of existence. Therefore, most users of financial statements study these statements carefully for clues to the company's liquidity and future profitability. In the short run, liquidity and profitability may be independent of each other. A business may be operating profitably but nevertheless run out of cash needed to meet its obligations. On the other hand, a company may operate unprofitably during a given year, yet still have enough cash from previous periods to pay its bills and remain liquid. Over a longer term, however, liquidity and profitability go hand in hand. If a business is to survive, it must remain liquid and, in the long run, must operate profitably. One key indicator of short-term liquidity is the relationship between an entity's liquid assets and the liabilities requiring payment soon. By studying the nature of a company's assets and the amounts and due dates of its liabilities, users of financial statements often may anticipate whether the company is likely to have difficulty in meeting its upcoming obligations. This simple type of analysis meets the needs of many short-term creditors. The concept of adequate disclosure is an important generally accepted accounting principle. Adequate disclosure means that users of financial statements are informed of all information necessary for the proper interpretation of the statements. Adequate disclosure is made in the body of the financial statements and in notes accompanying these statements. It is common for the notes to the financial statements to be longer than the statements themselves. Among the events that may require disclosure in notes to the financial statements are occurrences after the date of the financial statements. In addition to important subsequent events, many other situations may require disclosure in notes to the financial statements. Examples include unsettled lawsuits against the company, due dates of major liabilities, assets pledged as collateral to secure loans, amounts receivable from officers or other insiders, and contractual commitments requiring large future cash outlays. There is no single comprehensive list of the items and events that may require disclosure. Generally, a company should disclose all financial information that a reasonably informed person would consider necessary for the proper interpretation of the financial statements. Events that clearly are unimportant do not require disclosure. Determining information that should be disclosed in financial statements is another situation that requires significant judgment on the part of the accountant.